Well, greetings, my beloved clients and friends. It's our first video for the new year, 2023. We're glad 2022 is behind us. And I want to do an update today because yesterday was the CPI print for December came out. And I was actually very encouraged by it, and I want to tell you why. So the month over month increase in the CPI, or the Consumer Price Index, which is a measure of inflation, was minus 0.1%, which means it was down from the previous month. Okay, so if you annualize that out, it'd be a minus 1.2, which is way too low. The Fed doesn't want that. That would be deflation, and that they're as concerned about that as they are about inflation. When you look at Japan, for example, they've been in a rut for about 30 years, and it was those deflationary pressures. So they want to avoid that. And if you go back 2 months, in November it was up 0.1. So if you take the average of those 2 months as plus 0.1 and a minus 0.1, it's 0. So you annualize that and you get zero inflation, which is really good. And if you go back to the previous month, which was October, the month over month inflation was 0.4. Okay, so if you take that quarter, October, November, December, you take 0.4 plus 0.1 minus 0.1, you get 0.4, and you annualize that. 0.4 times 4 would be 1.6% inflation, which is very good. It's below the target. You go back 4 months, September, October, November, December. September was also 0.4. So you take 0.4 plus 0.4 plus 0.1 plus minus 0.1, you get 0.8 was the inflation over the last 4 months. You annualize that, take that 4 times 3 is, 8.8 times 3 is 2.4%, is the annualized inflation over the last 4 months. That's right in target. They want to be about 2 to 2.5. Okay, you keep going back 5 months. August, the adjusted CPI was 0.1. Okay, so you add up those last 5 months and you get 0.9. You annualize that and it's 2.16 has been the inflation for the last 5 months. You go back 6 months when we got the July reading, which was 0 month over month inflation. So now you have 0.9 inflation for the last 6 months. You annualize that, it's 1.8%. Very good. Okay, the last terrible read was in June, which was 7 months ago, and there was a month over month increase of 1.3%, which is extremely scary. Okay, and even when you annualize that in over the next 6 months, which were good, you get an annualized rate of 3.77, which is too high. Okay, but the point I'm trying to make is Powell started raising rates in March. He started aggressively raising rates in June. And if you look, it's worked. It has worked. Okay? Inflation for the last 6 months is really gotten under control. And if you think about the last year, you could see the change in just the overall economy, and you compare the first half of the year to the second half of the year. In the first half of the year, the stock market started declining in November. So the excesses of the stock market started coming out early, which they're always a leading indicator. So they started coming out, excesses in the stock market started coming out early. But the housing market was still on fire. January, February, March, April. you had to bid 100,000 over asking and to even have a chance, and everything was selling on the first weekend, and it was just crazy, right? That ended in June. It started to end in June, and July it really kind of abruptly ended after Powell started raising rates aggressively, and borrowing costs went from 3% to 6%. And so that's what he was trying to do. Stop this runaway freight train, control those insane excesses that we had seen in not only in the stock market, not only in the housing market, but crypto as well. The crypto markets also have corrected dramatically. You know what I mean? So those excesses that was in the crypto markets, there was these NFTs coming out and these just stuff blowing up. That ended in the first half of of last year. And it was happening in all kinds of assets. Used cars. At the beginning of last year, car lots were almost empty because there was such an insane demand for cars, for new cars, that it pushed up the demand for used cars to the point where people were flipping cars. You could buy, when does that happen? Conventional wisdom says the moment you drive a car off a lot, you lose money. That's just the way it is, right? That was not happening in the first half of this year. You could drive a car off a lot that you paid full retail for and sell it for a profit. Okay? That ended, right? So Powell needed to put the brakes on this runaway economy, and he did. Other areas that we've talked about, fine jewelry like watches, there was an insane demand for and the prices were going up like crazy, and same thing, you could buy full price retail and sell it for a profit. People were flipping watches, people were flipping cars, people were flipping real estate, people were flipping Nikes. I've talked about that. So it was just this runaway economy and this runaway inflation, and prices were just going up so fast that you could buy assets. You could probably flip eggs, you know what I mean? Because they were going up so fast, you could buy a dozen eggs and sell it in the parking lot for more. Powell fixed that. That ended. And you look at the last 6 months reads, and that's gone. That's a thing of the past. Okay? Now there's fear of recession. Now, you could go to the bank and get a CD for 4% or 4.5%, and so that's slowing down the economy. People are just, hey, I'd rather sit on cash than put it to work, and so I think he has effectively controlled inflation, and it's just a matter of time before those year-over-year reads get to where he wants them to be. And when you once we that June number, and the first half was they were all pretty bad. Once those numbers get out of the trailing 12, which will happen in July, we're going to get really calm inflation, assuming that inflation doesn't shoot up in the next 6 months, which it potentially can, but I doubt it, because you look around, it's not the runaway train that we had in the economy in 2021 and even into the first half of 2022. So when Powell is going to raise rates again, I think it's February 1st, I am expecting a 0.25% increase. And how many more of those is he going to have to do? I don't think he's going to have to do that many. Maybe one or two at the most. But then the simple fact that even when he's done raising, the overnight rate is what Powell controls, and it went from 0, and now it's up to 4.25 to 4.5. So he raises it a couple more times and he's almost at 5. I don't think we're really going to get to 5 because I don't think we're going to need to. But even if it gets to 4 3/4, that is restrictive. That is a tight monetary policy, and it will continue to slow down the economy. He doesn't have to keep raising. Even if he holds it at that high rate, it'll continue to slow down the economy. Think of it like this. The economy was just going too fast. So what do you do to slow it down? You break one of their legs, right? That'll get it going slower. And so pretty much that's what he did when he raised rates by 1/4, then 1/2, then 4 times at 3/4 and another 1/2. I mean, he broke one of the legs of the economy. Now you ask, does he still need to break the second leg? And the answer is no. Right? As long as he keeps that first leg in a cast, the economy is going to still hobble along, and it won't go full speed. So by keeping rates at 4.5 to 5, it's like keeping a cast on one of the legs of the economy. It's going to still slow it down, So I think the rate increases are rapidly coming to an end. Now policy is just going to be a little bit tight, and the excesses in most of the economy are gone. And you think, well, why was that? Well, we were shut down in our house and we had cash and we had nothing to do but spend money. So they spent money on stuff, and that was inflationary. Then they finally let us out of the house, and we went and spent money on experiences because we were tired of being locked up, and kind of those excesses got worked out, and now we're kind of back to normal, back to you go to the bank and get 4%, and companies aren't hiring like crazy. There's still the two areas of the economy that are still of a concern is housing and labor, because there's a housing shortage in America, and there's a labor shortage in America. Now, the housing shortage, raising rates definitely slows down the demand for housing because it increases the cost of housing. But it also slows down the supply of housing because developers, when they could borrow at 3%, a lot of deals pencil out. But when they have to borrow at 6.5, a lot fewer deals pencil out. So that rising interest rate slows down the demand for housing, but it also slows down the supply for housing. So, we're starting to see a mild housing correction, but I don't think it'll get really bad because of that, because there's still a supply-demand imbalance. And so one interesting thing about that December CPI, one component of it was still really hot, and that was housing. And housing is the biggest component of the consumer pricing. It's about 30%. And for the month of December, it was up 0.8% month over month, which is way too high. That's like 10% annualized. So that's a little bit of a concern. But I mean, it's widely known that the housing component of the CPI is very much a lagging indicator. And it's not that good of an indicator because we've talked about this before. For one thing, you can't raise rents month over month. You could, because rents are usually like a 1-year lease. So you could raise about 8% of rents every month. But the other ones, are not in renewal. So that creates a lag in that number. And the other thing is, renters account for about 40% of of living situations. The other 60%, 60 plus, are homeowners. Okay, and so when they calculate the cost of housing to put into CPI for homeowners, they use this thing called owner equivalent rent, which we've talked about before, which says if you were to rent the house that you live in, how much would it cost you? Well, that's a dumb question to 60% of that population, because you don't. When you own a house, you don't have to pay market rent, right? There's a group that have their house paid off, a small group, and then there's a larger group that have a fixed rate mortgage, and their payment doesn't go up, you know. And if they bought a year ago or more, they're probably the majority of them are in a 3% fixed rate, and so they're not seeing any inflation. So that number is exaggerated, and they know that, so they're going to discount that a little bit. So if when you take that out, that 30% of the CPI was up 0.8, that tells me that the other 70% was down more than the minus 0.1. So prices are really slowing down. Tesla today just announced that they're lowering prices on their cars by about 15%. And you don't think other retailers are going to be doing that when they see things slowing down? I was in the mall yesterday and it was dead. So aside from wage inflation, I think inflation is largely under control. And with this tight policy, it's going to slow down hiring, I think, enough to get wage inflation, somewhat under control. We still have that problem that there's fewer workers than we need. And Powell, we talked about before, that he doesn't have a good tool to fix that. But aside from that piece, the inflation and the runaway excess and stuff like that has largely effectively gotten under control. So I don't think he's going to need to raise much more. And actually, I think by the second half of the year, he'll be able to start lowering rates again. And that's a little bit more optimistic than the market in general. I think they got a little too pessimistic. They tend to do that. But we're starting to look at bargain hunting. Just yesterday, we bought AirBNB, which was a company that had gotten extremely beat up. But guess what? They have 80% gross margins and 20% net margins. They make money. They're not losing money. They're making money. They have $3 billion a year in free cash flow, and we could buy them for $60 billion. So that's a decent. The price of that stock looked pretty attractive, and so we started adding that to the portfolio. One other thing I want to add. That doesn't mean we're going to go back to 100% stocks. And what are we going to do with the money that's not in stocks? Like I said, short-term treasuries still look really attractive. We could get 4.6% on a 9-month treasury. And something else recently came across my desk, which is not for everybody because it's a little bit more long-term, but it was a preferred secured by $2.7 billion worth of Class A apartment complexes, and it's sitting at about, in the capital stack, at about 1.2 billion. So it's really high in the capital stack, and it's paying 6.3% for, but you have to hold it for 5 years. So for some people that might make sense to put a little bit in the portfolio. It is a long-term hold, but it's very secure, and man, that's a pretty decent rate on the fixed income portion of the portfolio. So there's starting to be some exciting things, that we could start putting that cash to work. I'm not going to go crazy, but we are seeing some opportunities that we're starting to nibble at. Okay, so I'm encouraged by the developments and for 2023. We're not saying it's officially over, or because there could be bad news tomorrow, but we're cautiously optimistic. So just wanted to give you that update, and like I say, feel free to reach out if you have any questions or comments, and I hope you guys have a great day.